Welcome back, everyone, to another edition of Insightful Principles. This episode is going to be very interesting. I actually have a special guest here on the show, Osa Winter. She's the marketing director and instructor for Florida School of Insurance. And that's how we initially met. I actually went through the insurance licensing process with Florida School of Insurance, and I was thoroughly enjoyed with the process and just the education behind life insurance and all of the different elements that comes with insurance. And within this episode, we're really going to go into details of talking about the basics of life insurance. We're also going to talk about disability income insurance, as well as some of the benefits that come with insurance in general, and how it's a transfer of risk. So you all are definitely in tune for a great episode. If you can continue to like, subscribe, and share to the YouTube channel, and if you're listening on the podcast, continue to rate and leave a review. It definitely helps. With that being said, welcome, Osa. I'm glad that you're here on the show today.
Hey, Kevin. Good to be here. Thank you.
Oh, of course. So to get things started, can you kind of share your background behind your passion for what you do with Florida School of Insurance, and what specifically made you want to become an educator in this space?
I fell into this just like most people in this industry. I graduated college. I went to Europe for a couple of months and backpacked and had a great time. And when I came back, I had no idea what I was going to do. And a friend of our family at the time was an executive vice president at the Bank of Tampa, and it's a local bank that services mostly a niche market. And I worked there for a couple of years, and really, I didn't enjoy banking. I was bored, and I was just partying a lot and just too young, just way too young and way too stupid. Um, and so I left that job, and I didn't have anything set up. I didn't have any backup plan or anything. And my mom and my stepdad, Betty Watson and Dave Watson, started the Florida School of Insurance 31 years ago, in 2001, in 1991. And so I'd been around this, growing up, and had worked in the office part-time for extra cash and things like that. And I was talking to my parents, and David said, he's my second dad, basically. He said, "Why don't you come run the school?" And I said, "I don't know anything about insurance." And he said, "So what? You've done banking. It's close enough. If you like it, great. If you hate it, go do something else." And I didn't have anything else going on. And I said, "Okay, sure. Why not?" And and that's how I ended up doing this. And I am so blessed for it. It's funny. We make our own plans, and then God shows up and is kind of like, "Yeah, here's what's actually going to happen," and like, guides you into where you're supposed to be sometimes. And that's what happened for me. I lucked out, and growing up, I never ever would have told you that I was going to work in insurance or in anything having to do with money. Right? I was growing up. I was very turned off by anything like that, because I had this mindset that, money is the root of all evil, and these things that people tell themselves, you know what I mean? And people that have too much money are jerks, and, all the nonsense that we tell ourselves. And that has not been the case. I mean, I will tell you that in the insurance industry, some of the worst people that I've ever met, that you want to take a shower after you shake their hand, are in this business. And some of the very best people who have the most integrity and are the most honest and will bend over backwards to honestly do what's best for another person are also in this industry. And I think that can be said for anything. That can be said for attorneys, for car salesmen, for plumbers, for whatever industry you're in. And so I had to let go of that mindset. And when I started teaching the classes, I really didn't know what I was doing. It took a couple of years for me to really get the material under my belt, where I had the confidence to be able to quickly answer questions, and really understand how things tied together. But it came together. And I've failed 1,000 times. I still fail several times every day, and I'm constantly learning, and just trying to better myself. And so that's how I ended up doing this. And I've been with the school now for 13 years. since 2008. October of this year will be 14 years. And I've been teaching for over 12 of those. And so it's been a learning process. And it's been a lot of fun. And like I said, I'm blessed. I really enjoy what I do. And it's really interesting because when I teach the classes, I get to meet people who came into the industry just like I did, right? They're in a major transition in their life. They're switching careers. They might be going through a divorce, whatever. Life has shown up and other industries aren't hiring, right? 2008 and during COVID. So twice in my short career, I've seen instances where the entire economy, it seems, is going backwards. People are losing their jobs. People are unemployed. People are underemployed. Meaning they're not getting paid enough. They don't have benefits, whatever. And both times the insurance industry is recruiting and hiring like gangbusters. And I mean, during COVID, for example, I know several people who have more than tripled their sales during COVID alone. And it's, when everybody else is starving basically. And it's one of those things that, again, in insurance, and everybody says this and I say it, insurance is a 4-letter word until you need it. And I think that that's because a lot of people don't realize what insurance does and the power behind it, especially when we talk about things like life insurance, disability insurance, long-term care insurance. Those types of things are not things that we think about every day, because we don't want to think about becoming disabled. We don't want to think about our own mortality. We don't want to think about somebody having to care for us when we're older, or if, God forbid, like I become a quadriplegic tomorrow. We don't want to think about those things. But when those things happen, or they happen to our family members, then we start thinking about it, and I think that right now, is an especially good time for you to start this podcast and be having this conversation. We've got over 10,000 people every day in the United States turning 65. I live in Florida, and almost half of those people, the last statistic I read was something between 4,000 and 4,500. So almost half of people turning 65 in the United States are doing it every day right here in the state of Florida. So over 4,000 people turning 65 every day in Florida, over 10,000 people nationwide turning 65 in the United States every day. And so that's a startling statistic. And so I think that people in that generation and people in our generation are having to grapple with those concepts, right? How are you going to handle Medicare? How are you going to handle your retirement planning? Do you have enough money for retirement? Are you able to retire and retire the way that you want to? And more importantly, what's going to happen if you live beyond your means, or if you run out of retirement income? And what's going to happen if you can't take care of yourself anymore? And, you and I were talking last week, and like I mentioned, last I read, the 95% of what people spend on healthcare happens in the last 5 years of life. And that's when you're on a fixed income. And it makes sense that it happens in the last 5 years of life, because most people don't die in an accident, right? Most of us die of some other cause, whether it's heart disease, cancer, whatever the case. And so those last 5 years of life, when you're trying to deal with those medical issues, is when those costs are going to show up. But those costs are also associated with things like long-term care, right? So not being able to safely live on your own, needing a home, needing somebody to come into your home, and that costs several $100s a day. And so I think that our generation and our parents' generation are suddenly, at a larger extent than was ever seen in history, having to deal with this issue. And at the same time, you have the cost of medicine skyrocketing, right? And the cost of pharmaceuticals skyrocketing, and it's compounding the issue. And now you've got market declines. And so you've got people that are in retirement who are worried about losing money in retirement because of the market doing what it's doing. And so there's, excuse me, all of these things culminating into a perfect storm for us to have this kind of conversation. And that's a long-winded way of saying thank you for being here. Thank you for letting me be here. And I'm excited to talk about whatever we have on the docket today.
Oh, of course. No, I love the passion, because I'm very passionate about financial education. And I think a lot of the points that you're hitting on is some of the reasons why we need to have this conversation, because there are not a lot of Americans, that have life insurance. Specifically, when I looked at the statistics, it was saying like in 2021, only about 52% of Americans have life insurance and 48% don't own it. And a lot of the reasons is They think it's too expensive, which I believe that's a misconception. And they also say that they don't really see a need for it. But when I went through the life insurance process with the company that you work for, it really even put a bigger emphasis of why you need it. I just think that you want to make sure that it's like you said, it's a four-letter word until you need it. It's like car insurance. You don't think that you need it, but you never know. Worst case scenario, if something happens, you're going to be much more grateful that you have it instead of not having it. So I wanted to start things off by at a very basic level. Can you explain what life insurance is and kind of just talk about how it's a transfer of risk and maybe perhaps any type of stories or anything that you may have experienced or just teaching within your classes that you can kind of share with the audience?
Absolutely. So like you said, insurance in general is just a transfer of risk, right? We all have financial risks that are part of our lives. So I'm a homeowner. My home could catch fire and burn down tomorrow, right? That's a financial risk. I could wreck my car tomorrow. That's a financial risk. I could die tomorrow. And that's a financial risk, not for me because I'm dead, obviously, but for my family members and the people that I leave behind. Now, I personally am single and don't have any kids. And so I am not necessarily a good candidate for life insurance, right? Somebody like me is not necessarily going to see the need for life insurance. If I die tomorrow, I really don't care what my family does with my house because I don't have anybody to pass it on to, right? I've got 3 sisters. I'm the oldest of 4 girls. They're all grown adults. 2 of them are married and have their own families. And so, we're all kind of doing our own things. And so if I die tomorrow and my house gets foreclosed on or whatever, I really don't care. You know what I mean? Like that's not going to have an enormous impact necessarily on my family. However, if I did die tomorrow, our business would suffer, right? So then you have a separate need, which is the need for key person insurance, where the business receives the death benefit so that they have the cash to keep the business afloat while they take the time to find and train somebody to replace my skill set. And when you have, we do business nationwide, and nationwide we're called American Online Insurance School. But when, at the end of the day, our immediate team is a small army. We have several people that we contract with for different projects, but our immediate day-to-day team, 9-to-5 team is a small army. And typically when you're dealing with like a small business like that, and we're certainly growing. I don't want to be a small business forever. But when you're dealing with a business like that, where you have a handful of people who are doing the majority of the work, if one of those people dies or becomes disabled, the business itself is going to suffer. So, you have business needs for key person disability income insurance, or disability insurance, where it pays the business a benefit if the key person becomes disabled so that they can pay somebody else to fill that skill set. And when you have a handful of people who are doing the majority of the work, typically each person wears 10 different hats. And so to replace one person's skill set, you might have to hire 3 or 4 different people. And that's going to cost money that the business doesn't have, because let's not forget that the key person is now dead or disabled. And so the income that key person was generating, it might be lost to the business, right? And so there's at least the immediate need for that in my situation specifically. Now, let's say that I did have a spouse and kids. Most households today are built on 2 incomes, right? You built that city on rock and roll is what I say. And if one of you dies, right, then you may not be able to afford the household, right? The surviving spouse may not be able to afford the household. And even if they can, like one of my sisters, if her husband died tomorrow, her income would allow her to maintain the mortgage, maintain the immediate bills of the household, but she might not be able to continue to contribute to her retirement plan. Right? She would not be able to save for an emergency. And that emergency savings is huge. I mean, you look at things like Hurricane Katrina, that happened in, I think it was 2005. There are people who are still trying to recover financially from Hurricane Katrina. Still. And so it's one of those things that, like, having an emergency fund is critical, especially when you're dealing with something like a tornado or a hurricane, because when those things show up and you've lost your home, not only is your home gone, but like half the city is missing, right? Half the city is missing their homes, is missing their roof. So even if you have the Cadillac of homeowners insurance, half the city is missing a roof. You're not the only one. So take a number. And your adjuster might be able to get out there pretty quickly, but finding a roofing company that's going to be able to patch up your roof or fix your walls, that's going to take a good 6 months before that work gets done. Meanwhile, your house might not be livable. So if you're lucky, you're living with family or friends. If you're not lucky, you're living out of a motel, paying 30 to 50 bucks a day on the cheap end for some, seedy cockroach motel that you don't want to live in, that doesn't have a kitchen. So you're eating out every day, right? Your job might be underwater, right? Or missing its roof. So you might not be able to work, which means you don't have an income, which means you're maxing out all of your credit cards. And you see what I'm saying? The domino effect begins to show up and you're going, holy crap, I don't have enough in savings for an emergency. And even if, let's say, your house doesn't burn down or the hurricane never shows up, if I become disabled tomorrow, or let's say that I end up hospitalized, right? I get in a car accident, I'm in a hospital for a few weeks. We all have deductibles, right? You have homeowners deductibles, you have car insurance deductibles, you have health insurance deductibles. Do you have enough cash to be able to handle those deductibles? Because if you don't, you're going to end up on a payment plan, and that's just one more monthly bill. And if you're hurt and you're having to go to, rehab treatments or chiropractic treatments or whatever, following the accident, following getting out of the hospital, now you're missing work. You might be losing income. So not all of us are going to lose our homes. Not all of us are going to become disabled. Not all of us are going to die early, right? The average life expectancy in the United States for a man is something like 80, 81 right now. For a woman, it's something like 85, I believe, last I looked. And so most of us live till later ages. But in the meantime, you do have these health issues that pop up, hospitalizations, medical issues, things happening with your home, stuff happening with your kids, whatever the case. And those things require cash. My point in bringing that up is that even if, say, my brother-in-law died tomorrow and my sister is able to maintain the bills of the household, if she's not able to set aside money for an emergency fund, when something does show up, it's going to kill her, or it's maybe not going to kill her, but it's going to be very difficult financially for a while because of that, right? It may be harder to make ends meet. If you had a life insurance policy that not only considered, let's say, you think $100,000 is enough. A lot of people throw these numbers around like, I've got, $200,000 of life insurance through my employer. Great. Do you know how long that's going to last you? Do you have a plan for how you're going to spend that money? Are you planning on paying off your house? Are you planning on paying off credit card debt? Are you planning on selling the car if your spouse dies tomorrow? Are you planning on living in the same house? Is that money going to be used for college savings for your kids? Is that money going to be used for an emergency fund, right? What are those? Where is that money going to be allocated? Because if you look at the needs, the financial needs of the average American household, and you actually take a look at what you would need to cover all of those things, the dollar amount can look like it's really big. Now, one of the things that you can do, let's say, for example, a really simple example with low dollar amounts. Let's say that let's say I'm married and my spouse makes $25,000 a year, right? Which I know is very low, but just work with me here. Let's say that my spouse is 25 years old. We're looking at buying life insurance. From the time that my spouse is 25 years old until the time that my spouse is about 65 years old. So let's assume 40 years of working, right? So the average American work life cycle. So if at 25, you're going to work until you're 65 and you're making $25,000 a year, if my spouse dies right now at age 25, that's $1 million of income that I've lost over my spouse's lifetime, right? If they die today, because 25,000 times 40 years is $1 million. So we're looking to buy life insurance. I can't afford $1 million policy, right? We can't afford those premiums because when you're 25, you're broke, and that's the way that works. And so, if you don't want to buy or spend money on a premium for $1 million life insurance policy, that's fine. What we could do instead is we could sell you a $500,000 life insurance policy. And if your spouse dies tomorrow, you put that $500,000 into an annuity that's earning a 4% interest rate, 4% fixed guaranteed rate, which is very conservative. You should be able to find any insurance company on the planet right now that's willing to guarantee 4%. That shouldn't be a problem. And if you annuitize it over the next 40 years, that annuity will pay me $25,000 every year over the next 40 years. So the annuity was funded with $500,000, but with just a 4% interest rate, it was able to guarantee me $1 million of income over the next 40 years. And that's a really big deal. That makes all of a sudden the insurance premium becomes more affordable, and you're leveraging your money in a way, right? You're stretching your money a little bit. And let's not forget that the premiums that I'm paying for that are way down here, and that death benefit is way up here. So I basically guaranteed myself $1 million of income over the next 40 years with this tiny little premium down here, which is going to pay out $500,000, which we are then going to annuitize, which guarantees $1 million. So it's like double leveraging in a way. And leveraging might not be the perfect word. I'm sure that you've got, CFPs and accountants and people who have a lot more degrees and letters behind their name than I do, who are going to hear the words that I'm using and might not like them. But I use those words as a conversational way to speak to the average American person who doesn't have an insurance or financial background, and help them understand, like, with life insurance, you don't necessarily need that much money in the death benefit if you have the right plan for what you're going to do with the money. I'll say one more thing when it comes to the house. And because, most American families, like we said today, both spouses are earning an income, right? Whether it's 2 men, 2 women, a man and a woman, whatever it is that you do, typically both parties are contributing financially to the household, right? And women earn almost as much on average as men today. And so it's about the same. And so if either of you dies, you have these financial issues, right? And so one of the things that people don't realize, or that they don't think about, even if you're single, right? Let's say that I'm single and I have kids. If I die tomorrow, my kids are not just going to inherit my house and all my other assets. They're going to inherit the mortgage on the house, right? Like, that mortgage lender still wants that mortgage paid. They really don't care that mom died. The bottom line is that now, Kevin, you, my son, are the one who owns the house, and now you're responsible for the mortgage. And if you can't afford to pay that, that's a big problem. And so what a lot of banks do, a lot of mortgage lenders do, is they offer what's called credit life insurance. It's decreasing term insurance. If you've ever bought a house, you know that what happens for about 6 months or a year after you buy the house is your mailbox gets flooded with insurance offers, right? Life insurance offers, disability insurance offers. And what all of those are meant to do is pay off the mortgage if I die tomorrow, or maintain my monthly mortgage payment if I should become disabled tomorrow. And that's an enormous benefit. I had a guy in one of my classes whose dad had retired. And when his dad was in his early 70s, he cashed out almost all of his retirement plan, like just all at once. So let's say his dad had $1 million in his retirement plan. He cashed out something like $750,000 of it, like almost all of it. And use that as a down payment. And this is back in like 2006, when if you barely had a pulse and like zero income, you could get a mortgage, right? So this is a very different time. But his dad cashed out about 3/4 of his whatever he had, an IRA or whatever he had, and use that as a down payment on a home. And this home was this enormous home worth like a couple $1 million on the water somewhere. And this guy in my class, Paul, and his brother were freaking out because they're like, Dad, what are you doing? You're in your 70s, right? You're in your early 70s. You're on a fixed income. There's no way you can afford this house. You're going to be broke tomorrow. You're going to lose the house. And his dad was like, I don't care. I'm going to die in this house. I've earned it. This is my dream home. I've worked long enough. I've always wanted this house. I'm getting it. So that's what he did. And sure enough, a couple of years later, their dad died. So Paul and his brother sent the death certificate and whatever, made the death claim basically to the mortgage lender so that they could have the title and the deed and whatever the paperwork is called. Even though I own a home, I never know what the paperwork is called. Have it all transferred into their name. And because they needed to sell the house. And the problem was that their dad died right after 2008. He died in like late 2008, early 2009, when the housing market took a collapse, like took a dive. And so he had lost value on his home. His home was worth a fraction of what it used to be. And so even if they were able to sell it quickly, they were going to sell it for less than what the mortgage was. And so they were still underwater, right? So they were still going to have part of that mortgage loan. And they were terrified because Paul and his brother couldn't afford the house. Like, even if they had sold their homes and lived in that big home that their dad bought, they still couldn't have afforded the mortgage. And so they were freaking out. They were terrified. And a few weeks later, they got a letter in the mail from the mortgage lender that said, congratulations, your house is paid for, free and clear. Paid for. And they're sitting there going, what in the world?
Sure.
And it turns out that the mortgage lender had offered the credit life insurance, and their dad took it when he bought the mortgage.
Okay.
And
Smart move.
Paul and his brother thought that his dad was starting to have funny symptoms and like knew like, oh crap, I think I might have some cancer. I don't know if he was peeing blood or what he was doing, but he had some weird symptoms, and they think that
Yeah.
he was suspecting that he was sick. And so instead of leaving his sons, like let's say $1 million in a 401k or an IRA that they would have to split between the two of them, um, and could potentially have, pardon me, have tax implications. What he did is he thought outside the bun, right? He was thinking outside the bun, and he
Yeah.
leveraged. And so he
Mhm.
used, 3/4 of his retirement plan to put a down payment on this home, and now he's left his sons with a home that's paid for free and clear, that's worth a couple of $1 million. Now, this is not perfect, right? You still have homeowners insurance, you still have maintenance, you still have utilities, you still have homeowners association fees, most likely. So you still have all of these bills associated with the home, but you don't have a mortgage anymore, which afforded them the
Yep.
ability to either sell it immediately, even if it was less than what the guy bought it for, because who cares? It's paid for. It's all profit at this point. Or wait until the market rebounds, because now you may be able to afford to do that, right? So it at least bought us time, or bought us a way to sell the house without having to still be saddled by a mortgage for a home that we don't even own anymore. And I'm not saying that that's going to happen in every situation, but I am saying that there are clever ways that people can use life insurance that most people don't think about. Most people think that a couple $100,000 is enough life insurance, and it may very well be. You might not need that much. But my point is to help people that are listening think about, okay, if my spouse dies tomorrow, or if I die tomorrow, what is that going to look like financially for my family, right? Right now,
Yep.
I've owned my house for 2 years, and somehow it has like 50% equity. Okay. But if the housing market collapses tomorrow, right, I may be 50% underwater, right? You just don't know what that's going to look like.
Right.
And accounting for those things and considering those things when you're planning out how much life insurance a family needs is critical. And you brought up an interesting statistic that 48% of people that have life insurance don't own it. What does that mean? That means that you're getting it through your employer. You're getting it through your employer.
Yep.
So the dollar amount that you're able to get is determined by what your employer is willing to offer. And typically that's based on a multiple of your salary, right? So if you earn $40,000 a year, you might be allowed to get 2 times or 3 times your salary. So $80,000 or $120,000, for example, of life insurance through your employer. And those benefits are tax-free. And that's great, but is that enough? And have you sat down and looked at the actual numbers and considered, is that enough? And do I need to supplement that? And I'll say one more thing that I think is critical. When we talk about group life insurance in my classes, we talk about conversion. Now, what that means is that if I leave my job tomorrow, and it doesn't matter how I leave, I could get angry and flip everybody off and walk out of the office and get fired, basically, or I could resign and give my 2 weeks notice the appropriate way. Either way, if I am covered under a group insurance plan through my employer, most states' laws, all state laws that I've seen, and I don't know every single state's law, so you need to call your carrier and see what's going on, but every state that I've seen has laws that demand that your insurance company, whoever's providing that insurance policy, that coverage, allow you to convert to an individual plan when you terminate from your employer, when you separate from your employer. It doesn't matter how. It doesn't matter if you were fired for cause. It doesn't matter if you retired, if you resigned. None of that matters. So, and in most states, it's something like 30 days. It may be more, but you need to call your insurance company, your life insurance company, and your health insurance company, because every state that I've seen has these laws that require the insurance company to allow you to change to individual insurance, and ask them, hey, if I left my employer, if I terminated employment, say on the 20th of the month, how many days would I have to change that policy over to an individual insurance policy, and how much would my premium be, right? What are my options? What would my premium be? And the insurance company can have that conversation with you. Most people that come through my insurance class, my licensing class, when they hear that, they're like, yeah, but my HR person told me that as soon as employment is terminated, all my benefits are terminated. Right, but your HR person is not a licensed insurance agent. And bless their heart, the road to hell is paved with good intention. And so your HR person is not a reliable person. That is not the horse's mouth. The horse's mouth is at the insurance company. And so it's really important to call the insurance company and ask them if you're able, how long do you have to convert? What are your options for conversion? Does it have to be whole life, or is it able to be term? What death benefit, it would be typically the same death benefit or lower. What is the price going to be? Those types of things, so that you know that you still have coverage when you leave. And that's for both life and health insurance. The only one that's typically not convertible is disability. So it's really important to have an individual disability policy as well. Sorry.
Yeah, that's a lot of great points that you're making, because I think for myself personally, I have insurance with the company I work with, but I also have insurance outside of work, because there's a lot of Americans that are underinsured. And, that was some of the statistics I was finding as well, that a lot of people think that they have full amount of coverage. But like you, going back to what you're saying, you really need to understand the financial needs of your family. If you have one, your spouse, you got to take into account your mortgage, possibly look into some credit life insurance, insurance to help cover those circumstances that may come up. So I actually have them both. So that way I have up to 10 times my salary. And I felt like after I looked at all of my costs, that was enough coverage for me. So I think, a great way is just really trying to look at all of your financial needs and seeing what's the amount of coverage that works best for your situation. And I would say that when it comes to, a financial plan, life insurance is at the foundation. I would tell anyone that, having a sound emergency fund, but having a fundamental life insurance plan, that's going to help you a lot, starting off as you're building your financial plan. And I wanted to get your thoughts on disability income insurance as well, because we talked about this last week, how, there's a lot more people more likely to get a disability than passing away before they retire. And I don't think people really think about disability and the power of it can really is used as an aid to replace your income if you have an injury, if you have an illness. So can you kind of talk about the importance of disability income insurance and some of the things you see within the industry?
Yeah, absolutely. The last statistic that I read, and this is going back 3 or 4 years, so the numbers may be slightly different, but the last statistic that I saw was on the Social Security Administration's website, and it was from the Federal Department of Health. And it said at that time that men in the United States are 3.5 times as likely to become disabled during their working years as they are to die during their working years. So between now and the time that you turn whatever your retirement age is, 65, 67, whatever, men are about 3.5 times more likely to suffer a disability during those years than they are to die during those years. For women, it's about 4.5 times as likely, because that baby bump is a sickness. And it causes hospitalization and disability, and a lot of other issues can come along with that. Now, that disability might be short-lived, or it might be a permanent disability. But the bottom line is that if you're disabled and unable to work, whether it's short-term or long-term, you need to have that income replaced during that time. It is critical. Arguably, one of the largest assets that we all have is our ability to work and generate an income. Most people think of their largest asset as their house. Your life insurance is also an asset to you if you own it. And so those are two huge assets, but a more immediate and possibly important asset, I would argue, is your ability to work and generate an income for yourself. Now, if that ability is taken away because of a disability, whether it's sickness or an accident, if you don't have money coming in every month, what are you going to do? And so you're basically begging on the street. Now, most of us have some kind of Social Security disability benefit. It's important that you consider age. In order to be eligible to receive a Social Security disability benefit, you have to be fully insured. And that means that you have to have earned, right now it's something like, I think, $6,000 every year for the last 10 years. And that changes periodically. So you would need to take a look. You can go on the Social Security Administration's website. You can create an account. I've done it. They verify your identity the same way that they would like a credit check. So like, where did you live in 1995? What kind of car did you drive in 2007? Those kind of things. And you verify your identity, and you can see what your current Social Security benefits are. So The last time I looked at my Social Security benefits was several years ago. Let's assume that my current Social Security disability benefit is something like $1,100, right? And that's really being generous. I'm only 40 years old, and so I would guess that it's probably even lower than that. I haven't looked at it in a couple of years, but I know approximately what it is. And honestly, I don't calculate my disability benefits and what I need based on Social Security. Right? I don't assume that Social Security is going to pay, because I have heard plenty of horror stories where people literally wait 3, 4, 5, 8, 10, 11 years before Social Security finally gets up off of it and is willing to pay them a disability benefit. It can be really difficult sometimes to get those benefits. And then other times you see people that you're like, how is this guy possibly disabled and he's getting a benefit from Social Security? There's nothing wrong with him. So I don't understand that. I'm not a Social Security expert by any stretch. I just know what I've seen. And so my point is that $1,100, if that's my only, disability benefit coming in from Social Security, if Social Security is willing to pay the benefit, which sometimes can be difficult to make happen, that $1,100 is not going to do really anything for me. That's not even going to cover my mortgage. And so, I think a lot of people don't consider that, right? And it's critical to consider that. And let's not forget also, if you're disabled, that means that you are under the permanent care of a physician. So you're going to have a lot of doctor bills, and that may mean that you're going to end up with a lot of out-of-pocket expenses, right? And so it is imperative to have enough disability income to get you through those times. Now, when it comes to disability, you definitely need to look at your income. The insurance company is going to want to know the income that you make. It's also important. Most people, when they buy an individual disability policy, which I would definitely recommend, when they buy an individual disability policy, they get a flat benefit amount. A flat benefit amount means that if, let's say that I'm currently making $50,000 a year, okay? And let's say that, I'm paying my insurance premiums, life is good, no big deal. And I have a disability policy. 10 years from now, I finally become disabled, right? And in those 10 years, I've doubled my income and now I'm making $100,000 a year. The problem is if I have a flat disability benefit, when I become disabled and I'm making $100,000 a year, it's not going to pay me 60% of that $100,000. If I have a flat disability benefit, it's only going to pay me 60% of what I used to make when I bought the policy, which is 60% of $50,000, which is only 30 grand. So that is less than a third of what I used to make. Now, that $100,000 of income that I was making right before I became disabled, that was taxable income, right? Because that's what I was getting paid through my employer. So let's assume a 30% tax bracket. So I'm really only taking home something like $70,000. Plus you have FICA tax contributions for your Social Security that comes out of your paycheck out automatically. That's 7.65% of your income. So let's just assume that you're only taking home 60% anyway, right? So I was only keeping something like $60,000 from that $100,000 anyway. But if I become disabled, I'm only going to receive $30,000 if I have a flat disability benefit in that example. You see what I'm saying? So now I have half of what I used to keep from my income. Plus I have all these doctor bills because I'm disabled. It's definitely not going to be enough to live on. Yeah. So if you have a flat disability benefit, it is imperative that if you get raises, if your income changes, that you call your insurance company and let them know about that so that your benefit keeps pace with your earnings. Because people never think about this. And what's so sad about this industry, and one of the reasons that I think that insurance is a 4-letter word for a lot of people, is because when was the last time your insurance agent called you? I ask my classes this. When was the last time your insurance agent called you? And every couple of classes, I would literally have one hand go up, maybe two on a rare occasion. And it just blows my mind how somebody can sell a financial planning tool which is going to cover you for years to come and not bother to call their clients every year. It is critical. Yep. And so, guys, if your agent hasn't called you in the last year, call me, call Kevin. Kevin, I'm sure, will call you every year, or knows agents who will call you every year. I know plenty of agents who will check on you every year, because you're just working at whatever job you have. You're raising your family. You're going by your day-to-day, trying to save up for a vacation, getting braces on your kids' teeth. You're not thinking about this crap every day. We are. And so it's really important that you have a good agent who's going to try to develop a relationship, because life changes, right? Everything that happens in life develops the need for the stuff that you and I do, Kevin, right? A birth, a death, a marriage,
Mm-hmm.
a divorce, a graduation, a retirement, right? All of these things,
Mm-hmm.
a new job, moving, right? Starting a
Life
business,
events.
like I just listed like what 12 things off the top of my head that generate the need for the stuff that you and I sell. And if you don't
Mm-hmm.
want to think about buying a product, then at least generate the need to have the conversation to make sure that your current products are adequate and that you're not underinsured, and
Mm-hmm.
also that you're not overinsured and you're not wasting money on
Sure.
premiums that you don't need. And so
Mm-hmm.
it's really important. But but to your point about disability, about half of American adults, I've seen that statistic quoted in a lot of different places, and with different numbers, but it's always right around half. About half of American adults have life insurance, and from what I've read, from everything I've read, only about 10 to 15% of American adults have long-term disability insurance coverage. So think about that,
Mm-hmm.
right? The unisex number is that you're 4 times as likely, 400% more likely to become disabled during your working years as you are to die. And yet you probably have life insurance and probably don't have disability income. So you're betting on the
Disability.
wrong horse, right? And I'm not
Yep.
saying that you don't need life insurance. And everybody says, yeah, but I know I'm going to die. Well, that's right, Einstein, you will, but you're much more likely to become disabled at retirement age than you are to die before you hit retirement.
Mm-hmm.
And so,
Yep.
it's like buying insurance for if your plane falls out of the sky, but not having car insurance.
Yeah.
Either one could happen, but
That's
which
so
one
true.
is more likely, right? The car
More
accident
likely to happen.
is likely, so why would you not have that? You know, and I just
Yeah.
and I'll end with this real quickly. I had a woman in my class. This was some years back, and she was in her mid to late 70s, 76, 77, from what I remember. And that's not the oldest person. The oldest person I've had in class was 81, but this woman was in my class in her 76, let's say. And what had happened was a couple of years earlier, her son had died. And her son at the time was in his early 30s. And when he died, he had been in a coma for almost a year from a major car accident. Now, before the car accident happened, the couple of years before the car accident, he had met a woman, got married, had a baby, and bought a home. So this guy's just doing life. And he was the breadwinner by a landslide in his household. And so he was out earning his wife by something like 3 to 1. He was making, say, 150. She was only making 50 a year, right? And so their household was primarily financially dependent on him, on his shoulders. And he has this major car accident, and medicine being what it is, they were able to get him in the ambulance, get him into the hospital, but now he's worthless. He's in a coma, right? Non-responsive in a coma. There was a short-term disability benefit that he had through his employer, which most people have through their employer, a short-term disability benefit, but he didn't have long-term disability. So there was still a check coming in every month for the first 3 months that he was in the coma, and then after that, nothing. And his wife is freaking out because there's no way that she could maintain their lifestyle, especially with him with these hospital bills, while he's disabled on just her income. And that's all she had was just her income. And so she's freaking out. And she was estranged from her family. I don't know what the situation was there, but she didn't have any family to lean on. She only had his mom, and he didn't have any siblings. So luckily, she had a good relationship with his mom. And keep in mind, they had a brand new baby who was like barely even a toddler, which is very expensive. And so she's like, what do I do? And the mom said, what about his Social Security benefits? And she's, oh, thank God. Yeah. Social Security. So the wife makes a claim to Social Security for the disability benefit, and Social Security denied the claim. And the reason is, from what I understand, and again, I'm not a Social Security expert, usually to qualify for Social Security disability benefits, you've got to prove that you cannot do any occupation, and a doctor has to certify that the disability is expected to last for at least 12 months, or that it's going to kill you in an earlier time frame, meaning kill you within the next 10 months. Or I'm sorry, 12 months. So you got to prove it's going to last for a year, or that it's going to kill you within a year. And when someone's in a coma, we can't certify anything. He could wake up tomorrow. He could die tomorrow. He could stay in the coma for 20 years. The doctors have no idea what's going to happen. So even if the doctor tries to certify, yeah, we think that he's not going to wake up, Social Security most likely is going to be like, yeah, we're not buying that. It's a coma. You guys actually have no idea what's going to happen. And they're probably going to deny the benefit. And that's exactly what happened to this girl. Meanwhile, she's got a mortgage. She's maxing out all her credit cards trying to maintain that mortgage, plus your big utility costs, your big homeowners insurance costs, HOA fees, right? Homeowner and all this other stuff that comes along with owning a house, plus a brand new baby, plus the medical bills of her husband, who's now not working, plus childcare. And his mom, the grandma, was able to watch the kid a lot of times, but she still needed help with childcare because she was working and trying to be at the hospital every opportunity she got, right? And so what ended up happening is about 11 and a half months into his coma, the wife and the mom together decided to pull the plug because they didn't want to, celebrate a year anniversary of the car accident. And so they pulled the plug and he died. Meanwhile, his wife has to sell the house, or it went into foreclosure. I'm not sure what she did, but I do know that she ended up being straddled by part of that mortgage after the house was gone. So even though she no longer owned the home, she still owed money on part of the mortgage. Her credit card debt was through the roof. And it was to the point that it ruined her credit so much so that she couldn't even qualify to get an apartment. She ended up having to move in with her mother-in-law, with his mom. And her mother-in-law, his mom, didn't have a retirement plan that included a new wife and a new baby, which is why his mom ended up in my class going back to work at 76, 77 years old, because they needed two incomes in the house. You know what I mean? And so just to help out with things. And so what you ended up with is a grandmother, a wife, and a child. So three generations of people being affected because one dude, the breadwinner, didn't have disability insurance. Now, if he had the proper disability income insurance, then that income would have been replaced. And I'm not saying that it would have been perfect. That wife still would have struggled financially, but she might not have lost the house. Yes. And she might not have had to move in with her mother-in-law. You know what I'm saying? Like, it would have been a lot easier transition than not having anything to lean on. And so it's really unfortunate what happens. And if you become disabled, even if you have disability income insurance, usually it's going to be a struggle financially because, again, you have all of these doctor bills. But it's going to be way easier than if you don't have any disability income insurance and all you have to lean on is hopefully Social Security if they're willing to pay the benefit.
Yeah, it's such important points that you're illustrating. I think that the disability income insurance, having that is going to be very beneficial because it's more likely that you may end up, not everyone's going to have a disability, but that's more likely to happen in comparison to you passing away before retirement. So you want to make sure that you're thoroughly prepared. And it's just unfortunate about that situation with the guy, how he was the breadwinner in the family and he didn't have the proper disability insurance to really cover the loss of income, and with him being in a coma, like you said, with the Social Security guidelines, if they can't certify the disability because, he's not cognitive, he's not able to certify himself, there's nothing they could really do. So that's one of the reasons why I think we're really trying to stress that make sure you have the proper insurance plan. And I also think too, another point that I wanted to stress is that you made a great point on keeping everything up to date as your income increases. If there are any life events that happen in your family, speak with your insurance agent to make sure that you have enough coverage to cover any changes. And I also would say, and we've had conversations about this as well, but keeping the beneficiaries up to date. If there's any changes with your beneficiaries, make sure that all of that information is up to date. So that way, if anything happens, you know exactly what's going to happen and who you need to cover. So all of those are very valid points. Now, one thing that I wanted to really talk on is like really building generational wealth with life insurance. I think people don't look at life insurance as a tool that can be able to assist with that.
Mhm.
Can you kind of just briefly talk on those tax advantages as far as with the death benefit? How the benefits of what you have when you have a life insurance plan, some of those tax advantages that come with actually having those plans.
Yeah, and I want to preface this by saying that I am not by any stretch a tax expert. I do not even do my own income taxes. I have somebody else do those. But what I know about life insurance taxation, annuity taxation, disability income taxation, those are things that I know for certain. And so those are things that I will speak to. It's always smart to talk to a CPA, a tax attorney, to have somebody else in your financial arsenal, right? Your team, because only having an insurance agent and not running things by a CPA or a tax attorney, only speaking to a trust attorney, only speaking to one type of person when you're talking about money, I think is very dangerous because especially if you have a lot of assets, it's really important to have a comprehensive financial team, a certified financial planner, an insurance professional, if it's not the same person, a tax professional, possibly a trust professional like a trust attorney, all of those things, and get all those people together in the same room, right? Have all those people communicate with each other and make sure that your wishes and desires are known to all of them and that they can talk to each other. A lot of CPAs focus on your current taxation issues, right? Your current income tax issues and help you try to save money for your taxes like right now. But sometimes they don't necessarily look like further down the road and what those tax issues are going to look like down the road. And so it's like I said, it's really important to have a team of people in the same room. What I will say and what I can speak to is like you said, life insurance death benefits, the death benefit itself, the death benefit proper, the face amount of the policy is always tax-free, period, end of story. I don't care who the policy owner was. I don't care how much money you've paid in the premium. I don't care how long you've had the policy. I don't care who the beneficiary is. I don't care what the beneficiary is. I don't care how much you had in the cash value. I don't care if the death benefit is $1 gajillion. Then when you die, your beneficiary can receive a lump sum check from the insurance company for literally $1 gajillion, however many zeros that is, if that's even a number, tax free, 100% tax free, period. Now, if you decide to take that benefit in installments, then those installment payments are going to generate a tax. So let's say, for example, that let's say that my mom has a $500,000 life insurance policy and that I'm the beneficiary. And let's say that that I decide to take that death benefit in installments over time. So I tell the insurance company, I don't want to receive, like she dies tomorrow, right? I tell the insurance company, I don't want to receive the $500,000 right now. I want you guys to hold on to that. And I want you to pay me that money over the next 20 years. Right. For example, I'm basically annuitizing. I'm basically turning my life and that death benefit into an annuity. That $500,000 lump sum death benefit is tax free, period. But if you spread that payment out over increments over time, then what the insurance company is going to do, what every financial institution does, they don't just let cash sit on a shelf and collect dust. They're going to put that money to use. And that money is going to be invested and it's going to earn an interest rate and it's going to grow. The interest that money is earning is going to be taxable income to me. Okay. That lump sum death benefit, the piece that represents what's now principal that came from the death benefit, the $500,000, that is tax free always. So the principal portion, the $500,000 death benefit is always tax free. Any interest above that would be taxable income to me as the beneficiary. And I'm just using $500,000 as an example because I don't care about the death benefit amount. If you have a death benefit, when the insured person dies, that death benefit is tax-free, period. Something else to keep in mind is that if you have permanent life insurance, like whole life or like universal life insurance, when the insured person turns 100 years old, the insurance company pays the face amount, which is what would have been the death benefit, tax-free as well. Being 100 is as good as being dead. Now, some insurance companies have actuarial tables that go to age 121 now, because the actuarial tables are the tables that tell us how many people we can expect to die at any given age, mortality tables. And they're a big part of how insurance companies do the math to figure out how much premium they need to charge you. But the point being that if the insured person lives to 100 years old, then the insurance company pays out what would have been the death benefit tax-free as well. And again, some insurance companies have actuarial tables that go out to age 121 because so many people are living past age 100 today. So it depends on the carrier, it depends on the policy, it depends on how old you are when you buy it. You need to look at that. But that's another added benefit. I don't know what a 100-year-old person is going to do with the death benefit, buy a new motor for your chair, but you can still get that benefit tax-free. Some of the other tax advantages of permanent life insurance, which again is anything with a cash value, so that includes whole life insurance and universal life insurance, are that the cash value is basically like a savings account. So a big chunk of your premium that you pay to the insurance company goes straight to the insurance company for the cost of overhead expenses and paying out claims. Okay. But a small piece of that premium is going to go into your cash value, which acts like a savings account. That cash value is being invested and it's earning an interest rate and it's growing over time. While that cash value is growing, the interest that's accumulating in that cash value is not being taxed while it grows. When you die, that cash value is part of the death benefit. It's included in the death benefit. It's not in addition to it. It's part of it. And that, like I said, all death benefits, lump sum death benefits are paid out tax-free. So even if the cash value is part of that death benefit, that's fine. It's all paid out tax-free when you die. You're not paying taxes on the interest while it grows. And you can take a loan against your cash values tax-free as well. Now, loans are not perfect, right? And so when I say that you can take a loan against your cash value, what's happening is if you do that, your insurance company is loaning you their money. So you're not getting your own cash value, right? The definition of a loan, any loan, is that it is somebody else's money. I don't care if you got a loan from your granddaddy, from the pawn shop, from a bank, or from the insurance company. A loan is a loan is a loan. And so if I take a loan against my cash values, let's say that I have $60,000 in my cash value, right? And I need to take a loan for $30,000 for half of it, right? The insurance company is going to give me $30,000 of their money, which means that tomorrow I still have $60,000 in my cash value. Now I don't have as much cash available because the insurance company, what they're actually doing is they're using my cash value as collateral for that $30,000 loan that they gave me. That's what they're actually doing. So, my dollar amount is the same, although my available balance is less. Okay. So the point being that loans are tax-free, right? Because it's not my money to be taxed. When I got my mortgage, if I have a $200,000 mortgage, I'm not going to include $200,000 as additional income, right? That's not my money to tax. It will be paid back at some point. So, and it's no different if you take a loan against your cash values. At some point, that money is going to be paid back. Now, I might pay that back while I'm alive. I might not make any payments toward that loan while I'm alive. And if I die, then the insurance company keeps what I owe them, and they just pay the difference of the policy to my beneficiary tax-free. So now, my beneficiary doesn't have to worry about paying off this debt from my insurance company, because there's not any. The only reason an insurance company would even be willing to make you a loan is because you already have the cash value available in your whole life or universal life insurance policy to cover it. So that's an important point to note. Now, another important piece to understand, a lot of people don't want to buy whole life insurance because it's too expensive, right? A lot of people get term life insurance because the premium is so much more affordable, right? And part of the reason for that is because of the time frame that you're covered. And part of the reason for that is because of the cash value, because part of the premium going into the cash value. Now, what you need to understand, though, is that if you have a cash value, right, and you need to take a loan against that cash value later, the insurance company already has your cash, right? They already have the cash value. And that's what's going to be the collateral for the loan. So when you take a loan against your cash values, the insurance company is not going to ask you to prove your income. They don't look at a debt to income ratio. They don't pull your credit score. You don't have to qualify for the loan. Literally, if I want to take that loan against my cash value so that I can go to Vegas on a bender with a bunch of drugs and craziness, like you see in the movies, if I want to do that, I can do that. No one cares what you're using the cash value to do. If I want to use the cash value to go on my dream vacation or my dream honeymoon, I can do that. The insurance company doesn't care. Now, if I had walked into a bank and told the bank, hey, I need you guys to lend me a bunch of money because I'm going to go to Vegas, they would laugh me out of the bank, right? Or because I'm going to go on my dream honeymoon, they would laugh me out of the bank, right? This acts, your cash value, an analogy that a lot of people use is the equity in your home. And that's not a perfect analogy by any means, but it's an adequate analogy for the language that most people speak. And so it's just collateral is all that it is. And again, it's not perfect. Yeah. Your interest rate for that loan through the insurance company is typically going to be a lot higher than an interest rate that you would get from a bank, especially if you have good credit. Okay. So it's not necessarily perfect, but it's a great option to have in your back pocket. If the crap hits the fan and financially you're between a rock and a hard place, it really would be nice to have that cash value to fall back on, especially considering you don't have to prove income or prove that you have good credit or even a job in order to get the loan from the insurance company.
Yes, it's a lot of great benefits with life insurance. You know, you've highlighted a lot of great aspects of, you know, being able to have the death benefit tax free. So it's not, you know, it's not, you don't have to worry about paying taxes. The beneficiary doesn't have to worry about paying taxes. And the only thing, like you said, to keep in mind is, you know, if you are doing the installments, and there's interest on the value of the policy, the cash value of the interest would be the only thing that's taxable.
If there's interest on
the death, just the death benefit.
Yeah, not the cash value. Yeah,
interest on the death benefit.
I think you meant to say.
Yeah,
I just wanted to correct that for listeners.
Yeah, the death benefit. But just as we're wrapping up things here, I kind of wanted you to just share if those that are wanting to look to getting their insurance license through Florida School of Insurance, where they can kind of go to be able to go through that process. And also if people want to connect with you, what are your different resources with them being able to connect?
Yeah, absolutely. So in Florida, we've been licensing in Florida for 31 years. Like I mentioned, we're called Florida School of Insurance. In 2013, I began an expansion for us to go nationwide. So we offer continuing education for current insurance agents nationwide. And we offer, there's only 3 states that we're not in, and that's Hawaii, Alaska, and Minnesota. And we're working on getting Minnesota approved right now, actually, and for continuing education. For pre-licensing, if you would like to become a licensed agent, then we offer that in 11 states right now. We were recently approved in 3 additional states, and so we're finishing up those practice tests and finishing up those law chapters and just cleaning up the course a little bit so it's easier for students to read. And so in the next month, we should have those other 3 states up and running, and we're going to keep expanding the licensing from there. So if you have an insurance license, I can help you pretty much nationwide. If you want an insurance license and don't have one, I can help you in 11 states. It's going to be 14 states very soon. And after that, we're going to keep expanding. So it's going to be a lot more before the end of the year. Nationwide, we call ourselves American Online Insurance School. And that's the same company. It's owned by the same people. And so, but we needed, we wanted to have a different name if we went nationwide, because if you're in Colorado and you see Florida School of Insurance, you're not going to click on that. So, but it's the same people. And we've got excellent courses. The online course reads like a play. It's very unique. It was actually taken from our in-person classes. So what you're reading is a conversation between the instructor and the students. And we teach with stories, just like I've been talking here today. We teach by asking questions, right? If this was your problem, what would you want? if this is what you needed to have happen, what would you want to do? And so we teach that way. It's called the Socratic method. And that's really what we're known for. Our practice tests are very thorough. The test bank is about 1,200 questions. Nearly every question has an explanation to tell you why the right answer is right, along with a link that goes back to the exact page in the online course that talks about that material. So it's a great resource. It makes reviewing the material very easy to do. So you don't have to go thumbing through notes. Saves you a lot of time. We have a video library. The video library is very, very thorough. I go into a deep dive on topics, and we've got some of those sample videos on our websites and a webcast. I teach a live webcast almost every Tuesday night of the year from 6 p.m. to 9 p.m. Eastern time. And that's for folks who are becoming licensed, who are getting their insurance license, and it's a review session. And it's a live broadcast, and you interact with me. I've got a whiteboard, and you type in, hey, I'm struggling with whatever topic, and I'm able to respond to that immediately. And we even record those sessions so that if you get interrupted or, whatever, you can go back and rewatch that for a month after the session was recorded. And so, it's different topics every Tuesday. It just depends on what people want to hear about, right? What they're struggling with, what they need to hear about. So not only that, we call our online pre-licensing students shortly after, like a couple of days after they purchase the course, and it's within a couple of days, usually the next day. And so we make every effort to stay engaged with our online students and help them understand that they've got resources available. My personal cell phone number is available on all of our websites. I encourage all of our students or anyone who's thinking about getting their insurance license to call me directly. You can call our office as well, but you can always call or text me directly, and email us, whatever. But we make ourselves personally available to our students, which I don't see from any other schools in this industry. It's a very unique approach that we take, and it's one that we encourage. Once you have your insurance license, you will only ever be unemployed by choice. Once a person has their insurance license and they keep it, so all you got to do is a little continuing education, which is really quick and easy, and maintain an appointment, which you can either do through an insurance company, or these days a lot of states let you self-appoint. And if you don't know what an appointment is, we can talk about that. That's basically just an insurance company giving you permission to sell their stuff. But you maintain an appointment, which is very easy. Typically, the fees are not very much. And so as long as you get the license and maintain it, I promise you will only ever be unemployed by choice. Once you have an insurance license, every insurance company, every insurance agency will be willing to at least give you a quick interview, if for no other reason than because you're already licensed. So you can pick where you work. You can pick who you work for. You can pick if you like that manager's approach, if you like those products, if you like the training that they have available. You can pick those things. And I just, knowing what I know now, if I was going to give advice to somebody who's coming into this into this industry, or who's thinking of coming into this industry, my recommendation would be that when you're in an interview, you interview the manager. If I was interviewing for a job, knowing what I know now, I would be asking, who's going to be my immediate supervisor? Who handles my training? What exactly does that training consist of? How long does it last? Are you going to do role-playing exercises with me? Are you going to go on cold calls with me? I want to know these things. I want to sit for a day or at least an hour with your highest producing salesperson, and I want to sit for at least an hour with your lowest producing salesperson, right? And I want to know what the average first year, second year, third year commissions are. Don't try to butter me up. Don't tell me I can make over $100,000 in my first year, which you actually can, that you legitimately can, but the vast majority of people don't, because they're learning how to sell. And you got to learn how to sell these products. Now, if you're selling something like health insurance, regular health insurance, like medical expense policies and Medicare, that's stuff that people have to have. So that's a much easier sell. But if you're talking about things like investments, if you're going to get a securities license, if you're talking about life insurance, if you're talking about annuities, if you're talking about disability income insurance, if you're talking about long-term care, all of those other products are completely emotional. And you've got to learn how to have that conversation with your client and help your client get honest with you and vulnerable with you about where they are and where they're trying to get. And then you've got to take the time to show them. Right. And so it's a very different sales process from selling a house or selling a car. It typically takes several touches before you make the close. But if you maintain that relationship, that person will be a client for life and they will refer everybody that they know over to you. And so you can really build your client base like that if you foster those relationships. But for those types of insurance sales, again, if you're selling stuff like regular health insurance or Medicare supplements, Medicare Advantage plans, everybody's got to have them. That's a pretty easy sell. But the other stuff is very emotional for most people. And so it really comes down to being able to learn how to have that conversation and guide that conversation for your clients and learn how to figure out what's best for them. And I mean, I know everybody, Kevin knows a lot of people. Guys, if you're not going to call us, call somebody so that you can talk about what your financial needs are. If you're looking at getting a license, I'm happy to help you with that. If I'm not in a state that you're in, I can try to help you find a school. I would have to Google it just like you would, or you can wait until we get approved there, whatever. But, if you're interested, if you're curious, if you have any questions, my cell phone is available on our website. In Florida, the website is floridaschool.com. Nationwide, we are American Online Insurance School, and that website is AOIschool.com. For American Online Insurance School, AOIschool.com. And you can select your state. Again, my cell phone number is readily available. Our office number is readily available. And you can reach out to me, my email, whatever. I'm happy to answer questions and get to know you guys.
Yes, and I'll put everyone listening and watching, I'll put all of Osif's information in the show notes so you all can be able to contact and learn more about the process of getting your insurance license. And, I'm a testament to say that, the program, I thoroughly had a great time and it was a great education for me with just learning about how life insurance works. Yeah, I did, and also was a great person on my circle that really helped me with a lot of different concepts. And one thing I can say is that Osa is very supportive. She wants to make sure that the students that she works with gets licensed and that they understand that this can be very transformative for you. Because it's not only changing your life, but it's used as a tool to change other people's lives. And that's why I decided to get my life insurance license. I wanted to help people, and I just enjoy that I'm able to have conversations like we had today with clients every day, and they're who I do my continual education with too as well. So definitely check them out, everyone. It's a great platform, a great school to be able to get licensed, and I'll put all of your information in the show notes. And I just want to tell you thank you again, Osa, for coming on today. I really enjoyed this conversation.
Thanks, Kevin. I enjoyed being here. Thank you so much. And if there's other topics that you want to cover in the future that you want to talk about, let me know. I'm always happy to help you out and be on here. And I love talking about this stuff. As I think you can tell, I could go on for hours and hours. But I really appreciate it. Thank you.
Me too. Oh, of course. We'll definitely do it again soon. And thank you all for watching and listening, and take care.